Guys, we've been getting a few questions in the Q&A after a few of our videos today refer to the 2s and 10s yield spread. Some of the questions asking what exactly is the 2s and 10s yield spread, how can we view it, and also how we can use it in our trading. So all great questions. Let's jump straight into them, looking at the first one then, and that is what exactly is the 2s and 10s yield spread. So this chart that you see right now is the 2s and 10s yield spread, a monthly time frame. And the first thing that I wanted to show you guys is how the chart tends to move in a type of sine curve, if you will. And these moves to the upside and move to the downside usually very closely follows the overall growth cycle of the US economy quite well. And it's basically just the US 10-year bond yield minus the US 2-year bond yield. And when the spread is moving higher, also known as curve steepening, it usually shows that the longer dated bond yields, in this case the 10s, are higher than the shorter dated bond yields, in this case the 2s. And when the curve is moving lower, also known as curve flattening, it simply shows that the longer dated yields, like the 10s, are lower than the shorter dated yields, like the 10s. So why is curve steepening, or a move higher in the spread, important? And why is curve flattening, or basically a move lower in the spread, important? Well, historically, an inverted 2s and 10s yield spread, which is this red line signifies 0. So an inverted spread, meaning that it dips below 0, has been one of the most accurate predictors and preludes of recessions in the US. There have been a few false alarms along the way, but generally it's been one of the most accurate anticipators of incoming recessions in the US, by being accurate enough to basically prelude, I think, the past 7 recessions, if I recall correctly. Now, why does the curve steepen or flatten in the first place? Well, it all comes down to the market expectations about monetary policy and the market's expectations about things like growth and inflation. In this case, expected policy changes from the Fed, and then, of course, expected growth and inflation outlook for the US. Remember that short-term and long-term risks are usually priced into the bond market well ahead of those risks actually materializing. So when the markets are anticipating that short-term interest rates are moving lower, or is going to move lower, we usually see bond yields reflecting that outlook across the curve. So as the economy starts to slow down, as growth starts to slow down, as inflation starts to grow down, markets will start pricing in potential rate cuts from the Fed, which pushes yields down across the curve. But when the economic outlook becomes extremely dim, we usually see that short-term yields like the 2s exceed long-term yields like the 10s, which basically means that even though shorter-term yields are falling, the longer-dated yields are falling even faster, as the longer-term outlook looks even poorer than the short-term, if that makes sense. So thus, a flattening curve, or a curve moving lower, is a sign of expectations of lower rates coming in due to slowing growth and slowing inflation expectations. So coming back to the curve, we can see from this chart, and I've basically plotted out the past few recessions as far back as the chart allows me to go, which is basically the recession of the 1990s, the recession back in 2000, and of course the global financial crisis back in 2007. And what we can see is that the curve basically flattens and then eventually inverts or drops below 0. And that is normally a prelude, or has been a prelude, to every one of these recessions, also the one that we just had. But something that's also very important, and a caveat to always keep in mind about this, is notice that the recession only starts, in all of these examples, the recession only started once the curve started to steepen. So once we surged back above 0 in all of these cases, only then the recession came into being. So in that way, think about the yield curve inverting not as a recession is a month away. It can take months before an inverted yield curve eventually leads to a recession. So what you usually see is that the curve tends to steepen just before or during the actual recession. Now, the reason explained by people much smarter than me for this happening is because the Fed is usually behind the curve when it comes to monetary policy. So that means that rates are cut a tad too late, which means that the cuts aren't enough to really stop the incoming recession. The curve simply front runs the expected cuts, and then as they start to transpire, the curve steepens as rates are cut and expectations for longer dated yields basically move higher than shorter dated yields, and then the expected recession eventually hits. Okay, so there have been a few rare occasions where the Fed has actually not been behind the curve, they've been ahead of the curve, where an inverted yield curve actually didn't prelude a recession because the Fed could cut rates quick enough to basically turn the tide. So coming back to what we're seeing right now, is that we're seeing that same type of steepening, right? Just after the inversion, now we're starting to see that steepening. So is this the steepening before the recession? Well, in true market talks, I think this time is different. Remember that the speed of the recession and the downturn that we've had because of COVID has been one of the fastest ones, if not the fastest one on record. And what central banks like the Fed has done, is they basically saw the problem coming ahead of time, and they threw in the kitchen sink in March, trying to basically stop the bleeding, trying to save the economies from the impending downturn. Also remember that the yield curve, it already inverted before COVID came on the scene back in 2019 in August. So a recession was already expected. And if you think about it, the expected recession did take place already in Q2 of this year. So right now, this steepening, in my honest and very humble opinion, is not a prelude to an incoming recession because we just came out of the recession in Q2. I think this steepening we are seeing is the market seeing that the short-term risks have subsided as positive vaccine news is basically calming the nerves and basically showing a reduction in the short-term risks in the market. And that requires less yield for holders of shorter dated bonds, and it means more yield required for investors holding longer term or longer dated yields or bonds. So like we've been highlighting for a while now in our commentary, in our reports, is that the markets expect the global economy to recover sharply going into 2021. And one of the big factors in that equation has always been an incoming vaccine. So the curve is steepening right now for the right reasons in terms of that overall economic outlook. And then, of course, the final question, how can you actually view this? Well, I'm viewing it on TradingView, which is quite simple. And let me just go to another chart and show you how you do this. Let me just use one over here. We can remove the election one now, I think. So how you view this is quite simple. Just go to your search bar in TradingView, and then you're just going to type in US 10-year, and you're going to subtract the US 2-year from that. Now, it won't show you a US 10-year minus US 10-year option because there isn't one. So don't look for it here. After you've typed in that equation, which is US 10-year minus US 2-year, just type in enter, and that'll give you the 2s and 10s spread. So guys, I hope the video has been helpful. Any other questions, please don't hesitate to let us know.